Welcome to the link for this week's edition, and it is brought to you by Standard Chartered Bank. We thank them for bankrolling us to make sure we bring you this information. And tonight we're discussing the US dollar versus the shilling, the exchange rate. It has always been there, it's always going to be there, but the issue is now it is what we call a bit volatile, but also the shilling is under pressure, meaning that the dollar is gaining strength and the shilling is a little bit weak. Perhaps not a little bit, actually. And tonight, my guest is Mr. Stephen Kaboyo, who is the MD Alpha Capital Partners, but also is the Honorary Counsel of the Czech Republic. Stephen, welcome.
Thank you very much, Sam.
I should say welcome again.
Thank you very much.
All right. The shilling is losing more value against the US dollar now. Please tell us what is happening to cause this.
Okay, thank you very much, Sam, for hosting me. I want to take it back and start from the point that Uganda operates a floating rate exchange regime, which means that the relative value of the currency is driven by the supply and demand dynamics. So that continually influences the direction of the shilling. Now, and in that regime, no government, no central bank would step in to defend the shilling. And that's what is the current practice here. Authorities will come in to manage the volatility or the fluctuations, smoothen out fluctuations, but they don't defend the currency. So the forces of demand and supply are what causes the value, relative value of the shilling. Now, if you take that a step further, in the current dynamics, we have an imbalance. An imbalance on the supply side against the demand side. Now you'll see that the supply side are literally the inflows, and the demand side is the outflows. So in the last couple of months, we've seen more outflows than inflows. And I'll explain what is causing that imbalance. Now, one of the things is because of the global economic developments, we've seen high oil prices, we've seen high prices of raw materials, and what is happening is that creates a lot more demand for the country to be able to import the goods and services from abroad. So compared to a year ago, we are demanding more dollars
to bring in things,
to import stuff more than a year ago. So that has increased the pressure on the currency. The other main factor, and there are two main factors. That's the first factor. The second one is when you look at the global economies, most of the countries are suffering from a surge in inflation. Now, when you look at the US, given the global influence of the US economy, inflation has hit a 4-decade high. So the central bank, which is the Federal Reserve of the US, since March has been increasing interest rates. So far 3 times. And many more times are up to come in the later part of the year.
So what does that have to do with us?
Now, what happens is when interest rates rise in the US, investors who are in riskier assets, for example, investors that have exposure to Uganda government bonds, tend to look back, what we call capital reversals. They look for a safe place.
Which is America.
Which is the US. And we call that flight to safety. Now, flight to safety basically means that investors are looking for safe haven.
Uganda is a bit more risky than US.
Much more risky than the US. So what has happened in the last couple of months is disinvestment of foreign portfolios going back to the U.S. because now the U.S. has become more attractive. As you recall, the last couple of years, interest rates in the U.S. were at ultra low.
Yeah.
But now they have gone up, which means the U.S. market is becoming attractive. At
the expense of the Ugandans.
Ugandans and other emerging economies. So globally, the U.S. dollar has become so strong.
So when they leave, what do they take away?
They take away dollars.
Ah.
They sell your assets and take away dollars. Now that requirement of dollars
in the market,
in the local market, puts a huge, significant pressure on the shilling.
So they also go to the Forex bureau or they go to the banks?
Every source. They will go to the bank mainly, but that's the main channel.
Yeah, it's the same market.
The same market.
Yeah.
So you see huge outflows against very little, huge outflows against very little inflows.
Yeah.
And that imbalance is what is driving the currency to even test the levels, record levels that we have not seen in many years.
I was scared a moment the other day, a couple of weeks, I thought it was going to go to 4,000. I was scared. But then now we are in 38, today 95. Yeah. Now, Stephen, if I don't deal in Forex, I don't deal with dollars, why should I care? What's happening?
You have to care. It's very obvious that this has a knock-on effect on all of us. One is through inflation. Once imports are expensive, that trickles down.
The shirt I'm putting on is more expensive.
More expensive. The goods that are imported become more expensive.
Fuel prices.
Fuel prices will remain high. That drives inflation, and that's the inflation we're talking about.
Yes.
That the central bank is trying to fight. So that inflation, high commodity prices, is really a result or outcome of what is going on right now. That's one. The other issue is, of course, inflation erodes value.
That's true.
And it has an impact on foreign direct investment. So it will discourage foreign direct investors from coming. Yeah. And the outcome of that is fewer jobs, which impacts on growth and many other associated.
And even you said, Stephen, value of money. It seems the value of money, the 10K, was going to buy less.
Yes.
If you have 100K, you're going to buy less because of that situation.
Absolutely. So that is the impact it has to all of us.
Either we know or we don't know.
Absolutely.
Okay.
Yeah.
I mean, okay. Now I know I'm going to be affected. If I'm in business, how do I try to shield myself from this phenomenon, or am I doomed?
No, you're not doomed. There are a number of strategies which I would call hedging strategies.
Yes, yes.
They are both simple and more complicated hedging strategies.
Let's go for the simple ones.
The simple one. The simple one is basically to take a position.
Okay.
And let me use an example of a seat belt in a car.
Yes.
When you're in a car, you don't know what is going to happen in the front there. So you tighten your seat belt.
Anyway.
You put on your seat belt.
Yes.
Saying, let me minimize the risks I might encounter as I drive. So it's a sign of protection.
Yeah.
Second example is insurance. When you insure your car, you don't know the day you're going to get an accident. Yeah. So hedging is basically along those principles, basic principles. Now the basic hedging strategy is to minimize your exposure by locking in a rate, either on the buy side or sell side.
Explain that, locking in a rate.
You can, let me put it in simpler terms. Yeah. You get into an agreement that I will buy dollars
from a bank, for instance.
From a bank at this rate. Yeah. I'll settle for this rate, but you will provide those dollars at a specified date in the future.
So it's a future thing, but you do it now.
Now. So that is the locking in of the rate.
Okay.
So basically, you're minimizing potential loss.
Whatever happens there for you, you have locked.
Absolutely. For today's rate. Okay. Because I don't know where this rate is going to move in the next couple of weeks. So you have minimized your losses. Yeah. You have managed the exposure. Your risk exposure.
You planned is locked in as a plan.
Absolutely. So that's the simple hedging mechanism. But there are many other complicated ones. There are future contracts. That's a forward we are talking about.
Yes.
A future contract is traded on exchange.
Yeah.
But that becomes more technical, and the mathematics around it is much more complicated.
Okay.
So that's on one aspect. But the other issue is how can businesses also protect themselves against potential risk? Is many businesses here seem to have this tendency of accepting obligations in dollars when actually their cash flows are in shillings. Now that mismatch is very dangerous. So today, as a word of caution, I would advise businesses and firms that do not take a dollar loan when you actually don't earn in dollars. Because to service that loan,
you need much more money.
Absolutely. So those are the things that one needs to look out for.
Okay.
On the wider picture, the whole issue of dollarizing the economy is also another issue to take into account, especially at times of volatility like this. Because if you're going to pay rent in dollars today, compared to 6 months ago, you need more shillings to be able to do that.
And yet things are harder.
Much harder. So the issue is do not take on dollar obligations if you really do not have a cash flow in dollars.
Would it be wiser, Stephen, for me to say, I'm going to minimize importation now? Is that wise?
Really, well, the issue is importation. There are certain imports that you cannot avoid.
Are inevitable, yes.
For example, fuel has to be imported. But one of the solutions is really to avoid what I would call non-priority imports at this time of volatilities like this. One that goes to even the government. We need to be thinking about substituting low-value imports.
Okay.
And that helps in diversifying the economy, and you focus on value addition through manufacturing, which improves your exports and adds value, and in the long run, that will stabilize the currency.
Thank you so much, Stephen. I can't believe the time has run out, but viewers, either you know it or you don't, the shilling exchange rate affects you. And if you're dealing directly with it, you're in business, you ought to mind. And you can do some things like Stephen has said to protect yourself from the current situation until it passes. We hope we added value to you. That was the link, and we thank Standard Chartered Bank for bankrolling us.